It's September 29th, 2021, and I just felt like it was time to just to have a conversation and talk a little bit about what's going on in the world. It seems like we're coming to some thresholds that potentially could be creating anxiety for folks, and I thought it'd be very helpful to look at several things. We're going to look at a little bit of history, but we're also going to talk about supply and demand and what's been going on from our Federal Reserve Bank, and just the effects of the monetary policy that they've put in place during this season of time relative to COVID this time around. Last time it was the financial crash of 2008, but monetary policy has been used in, and I'm going to explain that a little bit, along with stimulus from the government. And so when you combine those two things, that's an awful lot of what we would call easy money. And so there's a purpose for it, and the purpose has played out quite well. So we're getting ready to maybe change gears a little bit, and I want to talk about that and how that affects assets and how it has already affected assets a little bit. So the Fed has a couple mandates, but one of their main ones is that they want to keep inflation running between 2 and just maybe 2.25%. That's what they're looking at as a goal for inflation. And so when COVID hit, and it changed everything, and it dried up some labor pools, and our economy was in a free fall there for a little bit, you began to see the Fed get involved and start reducing interest rates, but they went a step further this time. They didn't just lower interest rates to make money easier to borrow for people, which I'm going to explain the outcome of that, but they actually went a step further, and they actually began buying bonds to the tune of $120 billion a month between U.S. Treasury bonds, corporate bonds, and even mortgage-backed securities and things of that nature. So the effect of that, when they're buying a bond, is that it keeps the yield low on that bond. So as you know, interest rates right now, I believe the 10-year this morning is at 1.49%. And yet, believe it or not, that's after a few days of drastic movement up. It was down at 1.3 just a few days ago. So that drastic move in the last few days, which was caused by a variety of things, I'm not going to spend a lot of time on that right now, but that drastic move did spook the market yesterday, for those of you that remember yesterday's market reaction to some of that. It wasn't just that movement in the 10-year yield that created that reaction, but that was part of it. I want to focus a little bit on that lower yield in the 10-year bond and what that has done over the last couple years with asset prices. So for those of you that have refinanced your home in the last couple years, you know that's been a nice thing, right? Lowering that payment and paying less interest. You're going to own your home perhaps sooner than you would have. For some of you, it might have been your opportunity to buy a home because interest rates are so low that it made it affordable to get out of renting and into owning your own home. And anyway, the whole purpose of monetary policy from the Fed's point of view is to get the economy moving again, and it certainly has done that. If you've been trying to buy a car, you know that can even be challenging right now. So along with money supply being very easy to get your hands on without paying a whole lot of interest, which is great for consumerism, we've also had this pandemic, which the government decided to do an awful lot of stimulus, extending unemployment payments and things along that line, as well as just the handouts that came our way. Some of that money went back into the economy, some of it didn't, but Americans are usually pretty good at spending what they have in their pocket, and that did take place, but it presented an opportunity for people to stay at home for a very long time, and that has created what we call supply chain issues. The process of getting goods and services moved around the world in a proper way in an economy that now is actually running pretty hot right this minute. So, and just a note on that, GDP, the International Monetary Fund, we call it the IMF, had their forecast for GDP, gross domestic product, this year in the United States In April, they had forecasted it at 4.5%. They just raised that to right at 7%. And so just to give you an idea, things are popping in terms of gross domestic product, which translates over into that we're seeing goods and services move, but we don't have enough people right now working to make the supply chains work right. So supply and demand, the rule of thumb is you can always count on that. When we have more demand than we have supply, prices go up. And it's even that way trying to get people to go to work for you if you own a company. And therefore, people are having to offer higher wages. But higher wages, some people think, well, yeah, I'm making more money than I used to, but that's not very helpful if everything you're buying is going up in price as well. So we're seeing a real supply and demand issue in our country right now, and that perhaps could last for a good while yet. It takes a while to get those supply chains flowing smoothly again, and down the road things will reverse, but it might be as a result of what I do want to say from MFG Wealth Management's point of view is likely to see that interest rates are going to continue to creep up a bit probably going forward. And as interest rates creep up and the money supply gets a little harder to get your hands on, a little tighter, so that's why they call it tightening, then eventually that can curb inflation. So right now, the Federal Reserve, who made the decision to lower rates and start buying bonds, has a very challenging road ahead of them. And so we're hopeful that they will do a good job of working through this. But they are probably come November going to start tapering. That's what they've indicated, tapering buying bonds. And so the tapering means they're going to start slowing down that process and backing off and unwinding the position that they have had in doing that. That'll be the first step. And then we'll see how that affects things, because the last thing they want to do is slow the economy down too much. We don't want to go into a deflationary environment at all either. So as workers come back and the Fed starts backing off on their bond buying program, then eventually we probably will see rates creep up a little bit. In order to put this all in perspective just a little bit, I want to show you one picture, and then we'll talk about some asset classes a little bit. But I want to show you one picture of what interest rates looked like in the 90s. So I started working in this industry in March of 1990, which, you know, hindsight being 2020, was just an incredible decade of growth in the United States, and a time to watch. Just fascinating what I got to witness in my first decade in the business. But this is actually a chart of the 10-year Treasury Bond, which is a benchmark that we often use when we're looking at interest rates. And the 10-year Treasury Bond, this is 1990 right back here. At this point, well, at this point when the decade began, it was at 7.82%. That was the yield on the 10-year Treasury. Remember, we're at 1.49 right now. And so people that are thinking, oh my goodness, rates are going up, they're not anywhere close to where they have been historically. And then the peak of the 90s, they got up to 8.89, I believe, right at 9%. Right up to 9% on the 10-year Treasury. So you can relate that to some degree. So a 30-year mortgage rate right now is just over 3%. 10 years at 1.49, so you can imagine what mortgage rates were if you were buying a house in the early 90s. And they went up and down, and Alan Greenspan, I believe, was the one making the decisions at the time, the head of the Fed. And I remember thinking every time he opened his mouth, the market moved. But at the end of the decade, 1999, the yield was 5.89 on the 10-year Treasury Bond. So much, much higher than we are now. And so from a fixed income point of view, yields are historically very, very low right now. So when we see a yield on the 10-year Treasury that high for a decade, you would think that would not have been good for stocks. But I want to show you what took place in the stock market during that same decade. So 1990, you can see this, it starts right here. And the S&P 500 is around 294. That's a weird number for us today. But 294. By the end of the decade, it was up over 400% at 1,553. So yields were more normal than they are today, much higher than today in the bond market. But because our economy was doing well and justified those yields, the stock market did even better, much better actually. And so I just thought it would be helpful for you to get a picture of the past relative to where we are today so that we can make rational decisions as we migrate through this. It would be very healthy if our economy continues to move forward like it is right now, for the yield on the 10-year to go up and rates to go up a little bit. And in no way is that horrible for stocks. So one other thing I wanted to show you is that depending on how your money has been invested for the past year or so, you might have a sense that the whole stock market's been doing great or whatever. But I want to show you this, that it's actually a market of stocks. There are sectors in the stock market that actually haven't done much in the last few years. But one particular one that I want to show you, because everyone's focused on the S&P 500 and how it's done, but there are whole blocks of the market that have been underperforming. This is a picture going back to January of last year, or of this year, excuse me, of the Russell 2000, which represents a big block of stocks there, 2,000 companies, and it is actually trading lower today than it was. This is in February. In February, is trading the Russell 2000. I'm using the IWM, which represents that, was trading around 230, and today it's trading at 222. So it's gone sideways this whole entire year. There are wonderful opportunities in that going forward, stocks that have not been moving, yet their earnings have been going up. So in reality, what we call the price earnings ratio they've been getting more, less expensive, not more expensive during the course of this year. The energy sector has been similar, and there's tremendous opportunities in that right now. And the financial sector is a sector of the market that I would tell you I think is going to be a huge beneficiary of interest rates going up. And if you pay any attention to what we call a spread, the yield curve is doing exactly what it's supposed to do right now, extending from the 10-year to the 2-year a little bit, the gap getting larger. And so that's wonderful for banks, huge way of how they make their money. And there's other areas of the financial sector that are going to benefit from this as well. Just let me glance here at my notes. And so I have lots more I could say, but I've talked too long already. Hopefully you're able to take what I've said today and give you some peace that the Fed is in the process of figuring out how to unwind what they've been doing, and we just hope they do a good job at it. And if they don't, we'll manage through it for sure here at MFG Wealth Management. But there is one more thing that is on the docket right now, and I think it's going to be great for a whole nother sector, what we call the cyclical stocks. But there's a large infrastructure bill on the table right now, and I'm talking about the one for roads and bridges and waterways and things of that nature. That's the bill I'm talking about, but I think that's probably likely to go through. That's just our opinion, but if it does go through, it's going to be very good for a whole array of stocks in the steel industry, concrete, you name it. And so I think there's lots to be excited about right now. There's plenty of anxiety out there right now, but we take one day at a time and we'll manage through this process. It's certainly not a time for panic and fear, and usually people make bad decisions when they're governed by those two things. So hope this has been educational for you, and we'll talk again soon.